and welcome to this week's edition of MFB News on this beautiful, beautiful day. Obviously, I'm completely moaning about the fact I'm too hot at the moment, having moaned for the last 11 and a half months that I'm too cold, but I'm British and it's my prerogative to complain about the weather, surely. But I hope you guys are really well, and I sincerely hope you're able to get out and enjoy some of this beautiful weather while it's here. In terms of what we've got for you today, we're going to be doing our usual roundup of what's been going on with swap rates and lender pricing changes. We're then going to talk about probably the three most exciting subjects I can conjure up for you at 6:30 on a Wednesday morning: tax, property prices and Bank of England base rate. So we're going to be going into each of those in a little bit of detail for you also this week. No, it wouldn't be an MFB News if we didn't talk about swap rates. So what's been happening there? Actually, it's quite positive, I'm delighted to say. So 2-year swap rates as of 10:45 last night, 4.267. Compare that to last month when they were 4.465, or even 1 year ago when they were 5.492. So year on year, we've seen a change downwards of 1.2%. And month on month, we're looking at circa 0.2% reduction. So that's really, really positive. 5 years actually. I don't know why I kind of fixate on 5-year fixed rates. I think because most people like 5-year fixed rates. And for a long time, I don't know if you remember, this is casting your mind back now, I was desperate for 5-year swap rates to go below 4%, which they did for a while, and then they went back over again. And they've been very, very slowly coming down. And we kind of got stuck at kind of 3.83, 3.85, that kind of level for absolutely weeks. Well, guys, this morning, 3.781. We've gone below the 3.8% mark, which to me psychologically for some reason is really fantastic. 1 month ago, 3.938, so we're sort of circa 0.15% lower than we were 1 month ago. And 1 year ago, 5-year swaps were at 4.750. So we are way down, sort of 1% down year on year, which is really fantastic. In terms of what's triggered this kind of sudden movement, and it's not a big movement, but it's still a movement downwards. It's hard to say. I suspect the recent statement that Rachel Reeves made, our new Chancellor of the Exchequer, made in government in Houses of Parliament earlier this week, which we'll talk about shortly, has possibly given some real kind of assurance to the capital markets in terms of how Labour are going to be sort of behaving in terms of fiscal responsibility. So that cannot have hurt things by any stretch of the imagination, whether you like or dislike some of the stuff she has mentioned. And believe me, there's some of it that I'd really dislike in there, actually from a kind of, responsible, being fiscally responsible perspective. Actually, she did do what seems to be a very good job. Now, in terms of how this all washes through to lender pricing, so keep in mind that for the last few weeks, swap rates hadn't really moved, so lenders' pricing hadn't changed, or cost of funds, hadn't changed. But we had been seeing kind of lenders adjusting rates, and I think I joked about the fact 0.15% was kind of like the go-to figure, because that's basically how much the cost of funds had reduced. So in the last week, we've only seen a very small number of changes. Now, I think this is going to be probably down to two things. So first of all, the fact that the cost of funds hadn't changed in the last week compared to previous weeks. And also it is holiday season, right? So things are just quiet, that's just the reality of the situation. Because we've now seen a slight step down in swap rates in the last week, we might now see, this might pave the way essentially for lenders to make further small adjustments. It's going to be nothing big, it's not going to be anything that's going to kind of have you gasping with delight. It's purely going to be kind of a small tweaking of pricing. But the good news is that it does open the doors for a further downward step in terms of lender rates. So in terms of the last week, we have seen Metro Bank actually, interestingly, reprice upwards by 0.3%. Now, there is nothing to be read into that other than the fact that Metro had some really, really keen rates. They are a lender who they have a kind of online application system, but their underwriting, they've always sort of prided themselves on the fact that their underwriting is done by a human, and they're able to kind of take a commercial view on cases and really sort of dig into the details and underwrite on a bespoke basis, which is fantastic. But what that means is it's quite time consuming. So when a lender like Metro release very good rates and they get kind of flooded with new business, it's going to kind of overwhelm them relatively quickly. So I suspect what's happened is that Metro had really keen rates. They've got far too busy. They've therefore had to reprice upwards just to slow things down. But we have seen rate reductions from other lenders, don't worry. Not everyone's putting their rates up. So first of all, we've seen Coventry bring pricing down by 0.1%. We've seen TML reduce their 5-year fixed rates by 0.2%. We have seen Land Bay drop rates by 0.1%, and Kent Reliance have brought their rates down by 0.35%. Now, With Kent Reliance, this is quite a big one, a reduction of 0.35. If you kind of think back to previous videos, if you do watch us often, you will know there are certain lenders that, you know, we talk about often in terms of their repricing. So, you know, for example, Landbay would be the prime example of this, of a lender who is often changing their rates. Kent Reliance don't do this. They're not kind of someone who is constantly reacting to market pricing. So their rates have been fairly consistent and not really moved for a few weeks now. So I think what's happened with Kent is they have purely have the opportunity to make a significant reduction because they haven't been taking advantage of the small steps down over the last few weeks. For those of you who aren't familiar with Kent Reliance, really fantastic lender, definitely a specialist lender. In terms of buy-to-let, where they kind of really excel. So first of all, they can lend to individuals and limited companies, don't have a maximum number of properties in the background. We've got clients with facilities of Kent Reliance of over £10 million worth of borrowing rights. They can really kind of pull the stops out for the right borrower. They, like I say, lend to limited companies. One of the really nice things with the limited company offering is they only take personal guarantees from the directors, not the shareholders. So not does that only kind of pave the way for landlords to have a limited company structure. It might be that, for example, children have some of the shareholding. It might be that you've got a brother who's resident in the United States. But also what it does is it also allows for layered companies. So the shareholder could be another company. So it allows for some quite complex structures. They can do HMOs of up to 20 rooms. And the other thing is they have a no minimum income requirement policy. So lots of great stuff in there, which is why it's really, really welcome to see their rates to come down. Now, finally, just to do a quick wrap up, in terms of where pricing is currently sitting. And I've kind of adopted the same model that I normally use, which is where I'm not going to give you interest rates where the arrangement fee is anything over 3% of the loan amount or is not flat. So what I've done is I've gone through all of the rates and picked out the first rate I come to where the arrangement fee is either 3% or a flat arrangement fee. I'm not going to quote you rates where the arrangement fee is like 9% of the loan amount, although there will be interest rates which are cheaper than the ones I'm going to give you, but they will have much higher fees. Okay, so just to kind of explain where I'm going from with that, because I always get someone email me saying, you know, I noticed you quoted a 2-year fixed rate of 4.2%, Jenny, but actually I've seen ones much lower than that. What's going on? So just to explain my thought process. So personal borrowing on a straightforward property, 2-year fixed rates from 3.84% with a 3% fee, and 5-year fixed rates from 3.83% with a 3% fee. Limited company rates on straightforward properties, 2-year fix from 4.89% with a £5,999 fee, and 5-year fixed rates from 4.69% with a £5,999 fee. HMOs up to, I feel like I'm doing the bingo or something here. HMOs, smaller HMOs, so those of up to 6 bedrooms, 2-year fixed rates from 5.14% with a 3% fee, 5-year fixed rates from 5.29% with a 1495 fee. Larger HMOs, so those with over 6 bedrooms, 2-year fixed with a 5.14% with a 3% fee, and 5-year fixed from 4.99% but with a 3% fee. So as you can see, things are kind of going, albeit very, very slowly, in the right direction. But it feels like we're kind of definitely on a good trajectory now. It's going to be interesting over the next few weeks. The next kind of big event we've got coming up will be the inflation data and then the base rate meeting in August. And we'll come on to that in a few moments. Okay, so Labour are now 2 weeks-ish into their reign, and we're starting to see them really get their teeth stuck into things. And Rachel Reeves was speaking in the House of Commons earlier this week. And what she has announced has really kind of caused a flurry of speculation with regards to whether certain taxes are indeed going to be increasing, despite Labour's pledges that they wouldn't be increasing taxes, which has always been, I think, a concern for quite a few people. So first of all, I think just to give some kind of context as to why this speculation is occurring. So essentially, Rachel Reeves announced spending cuts worth £5.5 billion as the new government is now seeking to address a £22 billion black hole in public finances. In a statement to the House of Commons, the Chancellor said the inheritance from the previous government is unforgivable. Reeves' statement detailed the results of an internal Treasury audit on the state of public finances commissioned by the Chancellor upon entering the office. The review found that there is expected to be a roughly £22 billion overspend on departmental budgets this year compared to spending envelopes laid out in the spring budget. The £22 billion figure included unfunded commitments from the previous government, such as £6.4 billion for asylum seekers and support for railways during the pandemic, worth just under £3 billion. It also includes funding for a 5.5% pay rise for workers across the public sector. The public sector pay rise, confirmed today by the government, cost over £9 billion, making a large portion of the black hole they're now looking to help fix. To help plug the gap in public finances, Reeves set out the immediate plans to make £5.5 billion in savings, helping to bring in-year funding pressures down to just over £16 billion. To fund the public sector pay awards, the Chancellor said she would ask departments to find savings worth around £3.2 billion, as part of which all non-essential spending will be on communications and consultancies is going to be cut. The Chancellor also announced plans to introduce means testing on winter fuel payments, which is going to save around £1.4 billion. The measure, which Labour says will target support of the most vulnerable households, will see the number of households eligible to receive the winter fuel payments falling from 8.4 million households to just 1.5 million. A range of infrastructure projects, including the A303 tunnel under Stonehenge and Boris Johnson's Restoring Your Railway Fund, were also shelved. Now, the reason I'm telling you this is to kind of give you an indication of, first of all, the size of the problem that Labour see that they have, and secondly, some of the means that they're now looking to kind of implement to address that. Now, I think the kind of key thing here is that the Chancellor did reiterate her commitment to not raising taxes on working people. However, the budget will almost certainly contain tax hikes, and the budget, by the way, has been announced for 30th of October. The Chancellor has reiterated her commitment not to raise taxes on working people. However, the budget will almost certainly contain tax hikes, which were not included in the manifesto, with capital gains tax and inheritance tax, two of the measures rumoured to be under consideration. The government also published a call for evidence today on its manifesto commitment to close the interest carried loophole on private equity. It also confirmed plans to introduce VAT on private school fees and extend the windfall tax on energy companies. For me, it's the private school fees one that's a bit of a killer. 20% on top of private school fees is eye-watering, but I guess that's what would be classed as a first world problem, right? But I think for you guys, the capital gains tax and inheritance tax is the biggie here. So first of all, what we're seeing some landlords doing who are contemplating selling properties is they're waiting to hear about the news on capital gains tax, because actually if they were to sell a property today and pay X amount of tax, but if they're going to sell it in 2 years' time, they're going to pay more tax. That's going to obviously expedite their plans in terms of what they do. The other thing we're seeing certainly is, I mean, we're always seeing people considering using limited companies, but actually in the kind of landscape where these particularly capital gains and inheritance tax are being talked about, people are now reconsidering using a limited company structure to be able to help kind of mitigate those. Now, I can't obviously give you tax advice because I'm not a tax advisor, I'm just not that clever. But what you will find is that with limited companies don't pay capital gains tax. What they pay is corporation tax. So if you sell a property, you wouldn't pay a capital gains tax on the money that's made, but what you would pay is corporation tax, as that money would fall into profit for the business for the year. In terms of inheritance tax, using a limited company, what this allows you to do is essentially have kind of a flexible structure in terms of shareholding. So what you can do is have a limited company where your children take some shares of that company, so they essentially get partial ownership, which can start off, from any age, basically. So people are kind of thinking about the future, about the changes or potential changes to capital gains tax and inheritance tax, and really wondering whether actually using a limited company could be a way to help mitigate some of these higher taxes, which we're probably quite likely now to face. If you are thinking about doing this, your next port of call is going to be a tax advisor who can really talk you through how you could use a limited company to set things up in a way to help kind of shelter you from some of these tax changes. Okay, now not the usual source I would look to use to quote for you guys in terms of property prices, but actually I found this one particularly interesting. So Aberdeen is an asset management firm based in Edinburgh, and they've published a report recently which says that the UK is spearheading a worldwide recovery in prime real estate assets following a period of political stability and market repricing after the availability of cheap mortgages ended. So the asset manager suggests that the UK now stands out as a bastion of relative calm in a more complex global political environment. Aberdeen forecasts that the total returns from UK property will average 8% annually over the next 3 years, which is absolutely, incredible actually, especially considering where we have been over the last year and a half. So Aberdeen have a person who works there, Anne Breen, who's the global head of real estate, and she told the reporter that she believes the real estate sector has now mostly repriced following the readjustments as the era of cheap debt came to an end. As a result, they have now upgraded their view on real estate to neutral after being underweight for around 2 years. And essentially, they think it's no longer the time to be underweight to real estate versus other asset classes. So essentially what they're saying is they are now regarding real estate, so residential property essentially, as an asset class which is going to be in growth mode. They further explained that this real estate cycle is markedly different from previous ones, as rental income has not faced the same challenges, and that means the recovery for future fit buildings should be faster, boosted by a lack of high quality supply. Aberdeen is particularly optimistic about residential, industrial and certain retail properties, which are expected to outperform the broader property sector. Breen highlighted that residential properties are attractive due to imbalances in supply and demand, while industrial and logistics properties are benefiting from the need for modern warehousing to support global and local distribution. Retail sectors that have adapted to changes in consumer behaviour since the pandemic are also performing particularly well. So I think there's just some really positive news. It's not just those kinds of places like Zoopla and Rightmove who obviously want house prices to do well, because that creates a better market, more favourable market for their kind of business, but actually even asset managers are really kind of feeling very positive in terms of direction of travel for house prices as well. Just something to consider if you are thinking about investing. And I know I bang on about this all the time, but all the indicators are there, and people across many kind of disciplines in terms of investment funds, estate agents, all those kinds of things. Everyone is now sort of thinking that house prices have really reached the bottom, are going to start to increase. And lastly, just a quick nod to what's going to be happening with base rate, or the thoughts on what's going to be happening with base rate in the meeting in August. So just to kind of cast your minds back, at the most recent base rate meeting, 2 members voted to reduce base rate, 7 voted to keep it where it was. The Bank of England have got a kind of really tough decision this time around, because while inflation has come down to 2%, which is where we need it to be, and that's really encouraging, actually underlying inflationary pressures, so for example, services inflation currently at 5.7%, that's alarmingly high, wage growth also really, really high. So there's kind of some arguments in terms of reasons not to reduce rates as well. So currently in the city, odds are in favour, 40% of people essentially believe there's going to be a reduction in August, so 60% do not. I suspect that actually the reality is, on my personal view, and obviously I'm prepared to be wrong on this, is that we won't be seeing a base rate reduction until September now. Now, the good news is that, or the thing to kind of be aware of, I suppose, is that for those of you who are in the market for fixed rates, the swap rates, the capital markets, have already priced in any kind of prediction of a base rate reduction. So what happens is, when the base rate goes down or up, we always get a flurry of phone calls with people saying, okay, I've just seen base rates come down, so can I have a lower fixed rate now? Or conversely, base rates just gone up, I guess I've missed out on the fixed rates now that we were talking about last week, or that kind of thing. That's not how it works. So what happens is, swap rates are a prediction of what's going to happen with base rate. So the capital markets have already priced in what they think is going to happen with base rate. Now, if something kind of really crazy happens, so let's just say, for example, which is a really nice kind of fantasy, in August, base rate gets reduced by 1%. Obviously, that kind of is a massive change that no one had predicted. So that would really impact swap rates. But assuming that there is no change, or just a very small change of 0.25% or maybe 0.15%, that's already been priced into the cost of fixed rates. You're not going to see anything materially change. So for those of you who are kind of waiting, particularly those of you who are paying standard variable rates of 9, 10, 11%, but are waiting for a base rate reduction to come in so you can get cheaper fixed rates, please just know that isn't really how it works. Actually, these base rate reductions are already priced into the market. So a reduction in base rate in August or September, if that's when it comes, doesn't mean you automatically get cheaper fixed rates. So maybe actually now is the time to consider acting to get a rate sorted, rather than kind of waiting for a change to come in where we don't actually know exactly when it's going to happen. And that's everything from me. I just want to say, I hope a lot of you are watching this video from the beach and you're somewhere fantastic. My holiday plans this year are fun but not particularly glamorous. I'm off to Norfolk, and then I'm going to the Isle of Skye, which will be incredible, but no lazing around on the beach for me this time around, sadly. But I hope you've got some lovely plans, whatever you're doing. The good news is, MFB are around all summer, and if you have any questions, we would love to hear from you. 0345 345 6788. And I say this often, but it really is a fantastic website. There is loads of information on our website if you were at home and wanted to go and have a nose around. Enjoy the sunshine. Long may it continue, and I will see you same time next week.